Hello everybody. Today this video is investing in a bear market. Today is Saturday, June 4th, 2022, and we are at least in the bear market of the NASDAQ. We have briefly touched the bear market status a couple times here with the S&P 500 this year. So before we get started on this video, if you look at the timeline of the video as you're looking at it and hover your cursor over it, you'll see that there's a number of chapters that we'll be discussing in today's video, and the chapter guide here will help you toggle back and forth and revisit certain subjects or skip forward to things that are of particular interest to you. So I want to introduce myself to first-time viewers of my videos. My name is Dag Olaf Magnus Brandfors. I go by Magnus. I am a investment advisor. I have been an investment advisor since 1992, and I am an independent financial advisor. I work with Commonwealth Financial Services out of Massachusetts with offices in San Diego as well. They back me up. They essentially work with long-tenured, high-quality advisors such as myself and provide excellent service to my customers and myself. They are an award-winning broker-dealer. They have won the J.D. Power Award for #1 independent broker-dealer years and years and years in a row. Fidelity Investments, through its subsidiary that handles institutional investing, National Financial Services, is the clearing firm that I operate with through Commonwealth. The purpose of this video is for educational purposes and for my clients to understand a little bit more about what I'm doing in this interesting bear market scenario. If you do have questions about this video, you can contact me at magnus@stellicuminvestments.com, and I will try and answer any questions you have. My broker-dealer does not want the comment section of my YouTube videos to be open for discussion or debate. I believe that might be a regulatory issue. So let's start with the first chapter, which is the objective. The objective is going to be identify a coming bear market, in this case, kind of already in one. The objective is also then to enter the market at a very low price, buy near the bottom, but very importantly, to avoid missing the bottom, and then to make the proper investments so that we fully participate in what will be the next bull market.
Let me tell you something, Mr. Sullivan. Do you care to know why I'm in this chair with you all? I mean, why I earn the big bucks?
Yes.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it. Nothing more. And standing here tonight, I'm afraid that I don't hear a thing. Just silence.
So, how to identify a coming bear market? You can't always do this, but oftentimes there are some tipped signals of the hand. One would be that the market goes through a very long, prolonged period of time of excessive returns. The risk-reward starts to look historically unattractive for investing. You notice irrational behaviors, and then also the commonality of hearing things like, well, this time is different, or this is a new economy, or this is a new that, or there's a new and improved this. Somehow you start hearing how there are excuses for why stocks aren't just overpriced, but should be even more overpriced than what they currently are. As a student of the market, you may be noticing that there's a lack of fundamental value in the market, that an exhaustive search of the markets will result in you not finding any particularly high quality company at a reasonable price with good dividends. Everything seems to be trading at its 5-10 year high, and all you have there are companies that, you know, one would potentially be buying as a momentum investment. Empirical evidence, that which you see with your own two eyes. You start to notice behavior in your daily life. You are getting stock tips from the shoe shine boys, is what they said during the the Great Depression that started in 1929. Cab drivers start telling Wall Street executives great tips. The empirical evidence, I pull up to a gas station and I notice that they're dealing Bitcoin from the gas station. At one point, I wondered if they were going to sell mutual funds out of 7-Eleven back in 1999. The television commercials of the Super Bowl become very investment oriented. In this case, the last one, the heavy amount of crypto. In 1999, it was day trading, do-it-yourself, internet online trading, etc. Inflation. The economy is starting to get a little bit out of control. The Federal Reserve starts to talk or act in such a way as to be providing a warning. Things just seem to be too good to be true, and for too long. Now, you can't identify every bear market. There are some that you'll never see coming. An example would be 9/11. You can't exactly predict that terrorists are going to fly airplanes into Manhattan, skyscrapers, or COVID, a pandemic, and the severity of it. These are things that you really just can't prepare for. In that case, what you would hope then is that you perhaps had a situation where you have reserves. This is a reason why people shouldn't be excessively invested or invested too aggressively during good times. You should take the foot off the pedal maybe a little bit, even when things are good. Okay, let's go to the next chapter here. Have a plan. This plan of what you're going to do, it really has to be in writing. And I can't emphasize that enough, because if you don't have it in writing, the goalposts are going to be flopping around, and you don't want that. Your written plan is, generally speaking, the idea is you're detaching yourself from fear and greed, and you're using logic. You're also making this plan in calmer times. It's hard to plan in the middle of a storm. You need to stick to the plan once the real trouble kicks in. Fear and panic is very common towards the bottom of a market. The behavior really starts to catch up to the tape. Do your homework, study history, have knowledge, wisdom, and seek professional help. This is much like planning for a vacation or a ocean-going vessel journey. Once you're out at sea with the ship and you hit a storm, you're going to have to make do with what you have. So before you leave the port, you're going to prepare accordingly so that should the storm come, you're ready. But in this case, I'm not talking about being ready for a storm. We're now talking about trying to capitalize on it and turn it into a fantastic return opportunity to generate wealth. Okay, the next chapter is, what does the plan include? Well, the plan should include what to do after you've identified the strong risk of a bear market. There should be a trigger event. What is it that you're looking for in this bear market to trigger you into some sort of a buying situation where you start to buy? The idea of having a trigger event is so that you don't commit too early or too late. I maintain a scorecard. There are certain things, for example, today, I am looking for events to happen that I can check off that will indicate that we're so deep into the bear market that we should be close to the bottom. But these check boxes need to be checked off before I can get overly optimistic. Otherwise, my entry into the market might be premature. Obviously, what will you be buying when the opportunity comes? Right now, I have already identified pretty much everything I really want to buy. I have a pretty good idea of what will work and what I don't think will work. And that's based upon my 30 years of experience and extensive reading of books and research of history and listening to interviews of economists that I trust and respect. Now, part of the plan is the management of bond risk. Most people think that, hey, I have a mutual fund and it has a balance between stocks and bonds. And these bonds, I've been told that bonds, in a portfolio will manage the downside risk. Well, let me tell you today that for example, the S&P Conservative Target Risk Index, it's a measurement tool, it's a barometer, as compared to the S&P Target Risk Growth, today, year to date, they're almost identical because this bond market has been very weak. And so just simply having bonds in your portfolio has done little or nothing to gain any sort of risk management. For example, you could be under this notion that I have bond exposure, so it's going to insulate me from stock market risk, and when there's a buying opportunity, maybe I can cash in some of these conservative bonds and go buy stocks. Well, if they're both going down at the same time, which is called correlation, complete correlation, then it didn't do you any good. So, but before the trouble starts, it may be important to dramatically reduce the risk of your bond portfolio by shortening the duration of time that the bonds mature within, and then the quality of the underlying investments. You may want to get out of, for example, higher risk corporates and get into much higher quality United States treasuries, for example. For example, your plan should include things that are like common sense orienting things, and say to yourself, well, what has always worked in a bear market? Okay, we're going to do those. And well, what has never worked in investing through bear markets? Oh, don't do those. For example, I could tell you what doesn't work is, for example, selling out in the middle of a bear market, running away from the pain, burying your head in the carpet, and then coming back when you feel a little bit better, and then put the money to work. You'll get so whipsawed in something like that that you'll lose on the way down, you'll lose on the way up, and you'll lose in the middle. So focus on the things that have historically always worked. Simple is good. You don't really have to overcomplicate things. Don't let your imagination run wild either. For example, on the upside, this time is different. So it is on the downside. You do oftentimes hear when things are really bad that, hey, this time is different. This time the market is down so much, and well, I'm pretty sure it's just never coming back. For example, in 2008, the TV set of Financial was really trying very hard to convince everyone that we were not going to have a V-shaped recovery. Instead, we were going to have an L-shaped recovery. Things were going to go straight down, and then they just simply would flatline for a long time because things were that bad, and stocks, bonds, real estate, whatever, it just wasn't going to come back. So be careful of the "this time is different" thing then as well. Now, and a very important part of the plan is over time, you're going to be buying. You're not going to try and pick the bottom. You're going to try and paint the bottom. So once your trigger events happened, the idea is to start a buying process that covers a certain period of time. In fact, let's take a break here, and I'm going to show you on my whiteboard what I mean by painting the bottom of the market. So let's go check that out. Okay, so here is what I'm going to refer to as painting the bottom. Okay, not picking the bottom, but painting the bottom. So, okay, here we got the S&P 500, 4,500, about 4,000 now, 3,500, 3,000. Again, this is just an illustration. So the market's going down, and your trigger point is certain events, but you've said, hey, at 3,500, I've decided that on the S&P 500, that's attractive enough for me to start my, 90 to 100 day buying program. So you start buying. Then a few weeks later, your timeline says buy more. And then it says buy more, but you missed the bottom. But you stuck with a disciplined timeline. Then you bought more. Okay, so your average is the blue line, okay? You didn't pick the bottom, but by painting the bottom, you got pretty darn close. And in the future, you're going to say, well, what difference does it make here, here, here? That was a pretty good entry point. So your average price, your trigger was 3,500, but your average price turned into more like 3,200 or 3,300. And so by doing this, you avoided the risk of missing the bottom. Because if you decide that you're going to try and pick the bottom, well, the market might start going higher, and then you decide you're going to wait a little longer and hope that it comes back down, and then it runs away from you. That happens a lot to people. So painting the bottom is what I'm going to do.
What have I told you since the first day you stepped into my office? There are 3 ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
Okay, so, all right, in the plan here, before the market goes down, before the trouble really starts, but you suspect trouble, well, you're going to want to create liquidity. You got this entire investment portfolio, and maybe it's fully invested, you've been bullish, but now you're starting to feel like it's time to prepare for this bear market. Okay, you are not going to sell the entire investment portfolio and be the smartest guy in the room and think that you're going to be wise enough to sell everything right before everything goes down, pick the bottom, and then ride it all the way up magically. That's the stuff for cocktail parties, but it doesn't happen in real life. My colleagues and I, we know we can't do that. We don't even try. So what you do have are guardrails, okay? There is, as an investor, there is the most aggressive you're willing to be to protect yourself from being wrong. And there is the most amount of conservatism in you and your portfolio to stop you from prematurely overdoing it on avoiding the market. And within that is asset allocation. So if you normally are the client that's going to be 70% invested in stock and 30% in bonds, perhaps you're going to try and get yourself to 30% stock, 10% bond, and the remainder of it in short-term U.S. Treasuries. But that's as conservative as you're going to go because, well, you may be wrong. But you may also want to do this over a period of time. So if you use a gear analogy, fifth gear being fully aggressive and first gear being extremely conservative, you were at a 4. Now you think trouble's coming, so you go from a 4 into third gear. And then as it starts to become more apparent that you're correct, you go from fourth gear, to third gear, to second gear. And then when trouble really starts to hit and the broad markets and bond markets and everything start to become a real problem, maybe you work yourself, down into second, perhaps even as little as first gear. But again, you are not going to completely sell out of a diversified investment portfolio. It's just foolish to do so. At the same time, you never know what's going to happen with your career in a really bad economy, so you're going to want to have some emergency funds. There may be career and income risk. In other videos that I have, what to do in a frothy market, I talk about paying off your bills, paying off your debts, building up cash. So you should be a very clean balance sheet personally by the time the trouble comes. So remember to, again, I can't emphasize it enough. You are investing, you are not gambling. This is not an all-out or an all-in game. You should be easing into the out, and you should be easing into the in. And it's multiple steps over time. Equity analysis, sectors, growth versus value, market cap, geographical region. As the trouble starts to become more and more evident and your thesis of a coming bear market becomes more and more correct, you should be asking yourself, what is at most risk in my stock portfolio? For example, is it these speculative smaller companies? Is it these growth companies? Are blue chips overextended? Are foreign stocks or emerging market stocks the guilty party of excesses? And you have to determine which of these has been the greatest contributor to the frothiness and the irrational behavior of the market. In this market coming into where we are now, it was the most sinful were smaller, story stock, growth-oriented companies, IPOs, but also some of the really high-profile names. For example, FANG, Facebook, Amazon, Apple, Netflix, and Google. They had become so entrenched in everyone's portfolios. By all description, they had become overvalued, and they are leading the way down right now, along with small cap growth. So a bit of a dive into the equity portfolio is certainly warranted. Now, on the way down, that's our next chapter here. When the market begins to turn down, all of a sudden the bad news is going to start to accumulate, and it's going to be done kind of slowly. You're going to get companies that have good earnings, but then they say, yep, the last quarter or this last year has been really good, but we do see some troubling signs going forward. We're not so sure that everything's going to be as rosy as the last year. And we're going to warn you that we may see a slowdown in our business. That would be called weak guidance. What also may come about are downward revisions. Eventually, Wall Street analysts will say, okay, we expect this company to not do quite as well, and so they start lowering their estimates for earnings, and that's called a downward revision. The other thing that happens is, as the beginning of the downturn starts, are that some well-known names, darlings of the world, all of a sudden have surprises. They say business is really bad, or we're really having a problem, and we've seen a few of those in fairly spectacular fashion here. We've seen Netflix and Facebook, in particular, of the FANG stocks, have had fairly dramatic declines in return because the news was surprisingly weak, and Amazon as well, for example. So surprises start popping up. These kinds of moves often start with a very sharp move down, followed by a sneaky little devil called a bear trap, where the original move down is very sharp and painful, but then the market starts to come back, giving it the appearance that this is a buying opportunity. And so this is your way, for example, we're told, hey, your favorite stock is now on sale. You missed out on this stock, but now you can buy it with some confidence. Or buy more of this company that has made you so much money. So that's referred to as a bear trap. Realize, too, that the stock market, unlike many other things, is a market barometer. It is not a thermometer. The stock market is saying what the future is going to be like. It's not telling you what so the stock market is telling you what the future is going to be. It's not telling you what things are like today. And so right now, for example, people struggle with the idea that the stock market's going down, but my job is secure, unemployment's really low, everything seems fine with the consumer. What gives? This must be a fake bear market. And so, but the thing is, eventually the economy will catch up to the stock market. and so will the real estate market. For example, we've been in a downturn now for 6 months, and it's only now in the last 30 to 60 days that there's starting to become signs that the real estate market will also be dragged down in this. And in my entire career, every major prolonged downturn in the stock market has eventually dragged the real estate market down with it. Now, on the way down, keep notes in writing, keep a scorecard, pay attention. Now, you're going to want to be patient. You're going to want to avoid being sucked in early because it's going to be tempting. You're starting to see things that you really like, prices that you can't believe that you're seeing. But if you have a plan, stick to the plan and avoid jumping the gun a little bit on a company that you're really interested in buying. With the time that you have, read, study, research, stay tuned in. In the latter parts of the way down, that's when fear and panic will finally start to kink in. And that's when you're going to be told by the television set that, hey, things are going to get worse. Okay, so now we're at the bottom, or pretty darn close to it. Okay, so now you had a plan, you've made some calm, rational adjustments to it as things are going down. As you are now in this fear panic stage going on in society all around you, you feel okay because you've got lots of cash. Not a lot of other people do, but you want to accept your written plan and try not to move the goalposts. So this is not a time to be tinkering. And you are just about at the point of time where you're ready to execute the beginning of the buying. Also, right now, you're saying to yourself, the historical risk-reward ratios are looking really attractive. You're starting to realize that at all the times in the past history, this as an entry point has every time generated a great rate of return. So when the risk reward becomes shooting fish in a barrel, then too, you're really close to the bottom. Of course, you're being told that, well, this time's different. We know about the past, and stock market goes back up again, and panic markets, etc. But things are so bad this time, they're never going to recover. That's a very common theme towards the bottom. And by the way, all the optimists, all the people that would agree with what we're talking about right here, they're out of bullets. They're all in. They're such optimistic type people that they never see the negative of the market, and there are advisors like this that they only see the positive. So their money's already spent. You're the last guy with the cash. This is also a very good time to make sure that you have detached yourself from fear, doubt, ego, and pride. Bad news. The bad news is coming out now in a really bad way. I mean, downright blood in the streets, they call it. The empirical evidence is all around you. Every time you open up the newspaper or the television or the radio, you're hearing about this company having laid off 10 or 20,000 people, this one going bankrupt, this financial institution being shut down because it failed. These are the kinds of things that are happening at the bottom of the market. But in the end, the bad news is coming, but the bears have run out of ammo. Now it's so bad that no amount of bad news is making the stock going down because the people left in the market, well, they just simply refuse to sell. And so what you've got now is capitulation. So at this point, we've seen the volume, the turnover of stocks as we're going down, reach a peak. And from there, the volume starts to decline because now nobody's selling. Nobody's buying either. But then a very positive event comes from out of nowhere. It's remarkable, or it's noteworthy. And that is, or it's the end of an obstacle. For example, the last time there was a huge up move was people really wanted to hold off on investing in the stock market until the presidential election was over. And so the entire summer and early fall, people were stockpiling cash waiting for the presidential election to end. Well, people don't wait for election day. A week or two beforehand, that's when they acted. But they didn't want to commit their capital until the end of the event. In 2009, the remarkable events, or the positive event, was one of the major banks in the United States came out with unbelievably positive earnings because the Federal Reserve had made it like shooting fish in a barrel. So all of a sudden this bank, which had been in real trouble, all of a sudden was flush with cash making money. And Bernie Madoff, the financier with the Ponzi scheme, spent his first night in jail. So the next chapter here, on the way up. Now we've entered the explosive upside movement. And now you should be fully into doing buying. Now, as the market goes up, this television set is also going to be telling you that, well, this is a fake rally. This isn't real. This one, don't believe it. There's just too much bad news here to make this for real. And also, the volume has gone from lowering to now spiking higher. So volume is increasing as the real upturn is happening. As the upturn happens, there's disbelief by the public. The public doesn't understand how the stock market's doing so well when they personally are so miserable. Again, it's not compatible with empirical evidence. Here the stock market's going up and everything around you in society, things look bad. But again, the market's a barometer. It's predicting that 6 months from now, 12 months from now, 24 months from now, things are going to be much better. So as the market's going up and your plan is being enacted, you've been doing some buying, but you notice that some of your ideas are really working well, but maybe a few of them, they're just not participating for some reason. Those ideas you will want to cut quickly. Cut those out and add them to your winners. For whatever reason, not every single sector of the stock market or bond market is going to participate in the next bear market rally. Some of the stuff is going to be left behind, or maybe it even continues to go down. So cut the non-performers and add them to your winners in a relative hurry. The market for a year or two will be climbing what's called a wall of worry. Nobody's going to say, hey, congratulations, you did a great job. Yep, you won. You're making lots of money. You picked it just right. You will hear worry and doubt the entire way up. The worry and doubt will finally come to an end when pretty much most of the upside is gone. Okay, many of you watching this video are not my clients, and I just wanted to talk to you a little bit about getting help. Some of you watching this video are either going to be do-it-yourself investors, or you're going to be people that have investment advisors already on your own. First I want to address the do-it-yourself crowd. Realize that you've got you have a pretty serious handicap here. One, you're not licensed. In order to become a financial advisor, had to study under a New York Stock Exchange member firm. I went to training classes. I had to study and take my Series 7, my 63, insurance licenses and things like that. I needed to actually be, educated and tested on these things in order to become a professional. And that was just to get me to day one. I have 30 years of experience. I have knowledge of bear markets. I have knowledge of senior citizens. I have knowledge of how capital markets work this way, that way, and another way. I also have incredible resources from Commonwealth, Fidelity, etc., and strategic investment partners. I also have the time. I do this professionally. During normal times, I'm working typically 40 or 50 hours a week. And during extraordinary times like this, I might be working 60 or 70 hours. So being able to do what I'm talking about here does require time. Personal attachment. It can be very difficult for anyone, even a professional, to manage their own money because there's something about that money being yours. In fact, I have seen my colleagues, many of them, it's very common for these investment advisors when they're managing their portfolios of their clients, they tend to be a certain risk reward level. But being that they feel that they know so much about the markets and they're close to it and they're watching it like a hawk, oftentimes these people take a much higher degree of risk to the point of recklessness. Knowing that myself, I try to do exactly what I do for my clients, except for in some instances I do employ leverage, but I'm investing in the same companies that I have invested for my clients. One of the problems for a do-it-yourself investor is, to a degree, it's like taking candy from a baby. The media and the bad parts of media can employ very, very powerful tactics against the public and get people to invest in ways or companies that may not necessarily be prudent for them. It's also potentially a good way of becoming a fraud victim. So in my personal opinion, I think that of all the people I've ever met and had deep, meaningful conversations about investing with, I'd have to say, frankly, that 95 to 99% of people are nowhere near capable of managing their own money without assistance. So now, for the people that have an advisor, okay, so let's say you have an investment advisor and you're watching this video. Some things I want to bring up to you is, I currently have 100 clients. They have been with me for a very long period of time. So I have a limited clientele. They know me quite well. I have complete discretion over all of my client accounts. I manage their account without having to call them or meet them. If an advisor does not have discretion and they have to pick up the phone or sit in a meeting with a client to discuss the rapidly changing markets, and then they have any meaningful number of clients, as you can see, that is not going to be a very effective tool for managing a customer's money in a time-sensitive, volatile market situation. So how would you go about dealing with that if you have an advisor that, and generally clients know how big or how powerful or successful their advisor is. If you feel that you're at the risk that your advisor may not be able to get to you quick enough in a fast-moving market so that you can maybe take advantage of what we're talking about here, then it's up to you to be proactive. Then you should be the one calling them. Don't wait for the phone call. Go to their office and say that you want to be a little bit more aggressive on getting out of the market before trouble starts and to really wait out a buying opportunity. And now the advisor may say, hey, I've already got you in all these good investments, buy and hold and be patient, everything's going to be great. If you don't agree with that, the time to do something is going to be before the trouble starts. And if you don't agree with the advisor, then tell them so. And come to something that you find agreeable. Again, you may simply go to your advisor and say, hey, we've always worked on a non-discretionary basis where you meet with me and you call me, but in this market, I want to tell you what I'm looking for, and I'm going to give you legal discretion to manage my money. Been with the guy for a long time. You trust the person. They know what they're doing. Why wait for the phone call or a meeting? Let them do what they're trained professionally to do. So if you can, get that advisor of yours to take discretion of your account, either permanently or temporarily. I took discretion over my clients' accounts when it started to get to the point where my clients kept saying, well, you know best, I trust you, do what's in my best interest. At that point, I really needed to stop the old-fashioned way of doing business. Hiring a professional advisor is it's not that expensive. If you feel that paying an advisor something in the neighborhood of about 1% a year of your assets is expensive, I think you may have misguided notions about the value of a professional investment advisor. When you think about it, 1% fee per year, the volatility of the stock market, is oftentimes significantly more than 1% in a day. So paying the advisor one volatile day per year, that's a pretty good bargain. Now, if you're looking for an advisor, it's very important to make sure, or you have an advisor, you need to match your advisor. If you have a little money and not much experience, you can't very well go to the biggest, hottest, best financial advisor in town and get him to be your advisor. He may accept you, but the fact of the matter is you aren't compatible to what he is interested in. So if you're a small fish, you may need to go to some place that kind of emphasizes helping out the smaller or younger or beginning investor, or you find an investment advisor that's early in their career. So if you're looking for an advisor and you're kind of a beginning, starting off person, a couple of good ideas for you are your local bank. Most of the major banks have investment programs in them. So go interview 2 or 3 investment advisors in these banks and see who you feel comfortable with. Those advisors are going to have a boss. You may ask for the boss's name, call the boss and say, hey, you're the boss probably of 20 advisors. Here's who I am. Here's what I'm looking for. Here's where I live. Can you tell me which of your advisors would be the best suitable choice for me? That would be a very intelligent choice. I wound up with many of my clients that way from a former boss of mine when I worked in the banking business. And it turned out to be quite good. It's an intelligent way of finding an appropriate advisor. Another financial institution where there are younger brokers starting off and they have a very good educational program and it's community oriented is Edward Jones. So wrapping things up, the rewards of identifying a bear market, having a plan, and capitalizing on it can be very, very profitable. It also does a great job of avoiding the losses of that said bear market. So in that, I wish you happy hunting and good luck.